Hey, this is Jake Adams, CPA. We're going to be talking right now about the top tax strategies that you can use before the end of the year is up to save as much as you can on taxes. So we're going to spend about 20, 30 minutes. I'm going to go through things pretty quickly. If you have any questions on it, please feel free to let me know. Drop it in the messages and the comments down below or shoot me an email. Let me know how I can help you out because this is really important. We've only got a couple weeks left here before the end of the year. So first and foremost, we're looking at the revenue streams, your income that's coming into you. And we're going to call this money, right? Commissions, income, revenue, sales, whatever it is that you're doing, the income that's coming in. So first and foremost, and number one is how can you either put a cap to this or how can you slow it down? If you have accounts receivable, which is you're waiting for people to bring money into you or pay you, can you say, hey, just hold on to that money, don't pay me until January? That's called actually delaying receivables or delaying payments or slowing down payments. So basically the goal for that is to, instead of taking it in November or December, take it in January. So you're only without the money for a couple of weeks, but by doing that, you're going to be delaying the taxes. You're going to be putting off that taxable income until next year. So this is a really easy to use strategy. All you have to do is contact, if you're a real estate agent, your broker, just say, hey, if I have any commissions, can you hold those off until next year? Sometimes they'll do that, sometimes they won't. If you have receivables, if you have customers that are paying you money, you can ask them to just hold that off. They might want to do that, they might not want to do that. And it's completely different for different industries. So you're going to have to figure out if this works for you or not. So that's your number one, is to delay those receivables or delay your payments. Now, one really important fact I want to mention about this is that if someone does pay you, let's say someone gives you a check, you can't just hold on to the check and say, I'm going to deposit in January and that's going to delay my receivables or delay my payments. No, the IRS has what they call constructive receipts. And constructive receipt is when you actually have the receipt of the check or you have received that payment, but you're choosing not to deposit it. So if you have constructive receipt of a payment, you can't delay your deposit of it. You still have to recognize that revenue because you received the check for it. So that's number one. So number two is very similar to that, where you're going to have expenses, right? So you're going to have expenses off your business. So expenses is number two. You can actually accelerate those expenses. So some things that you may be able to pay for here in the last couple weeks of the year, maybe things like prepaid insurance, right? You can contact your insurance agent, your insurance company. Can you say, hey, I have a policy that's going to be, next year. Can I pay that this year instead? And they might be okay with that, right? They might allow you to prepay that insurance policy. So you can also prepay other things, prepaid insurance, prepaid interest, prepaid, expenses. So look at your expenses, look at your vendors and contact some of your vendors and say, hey, is there anything that I can prepay now that you can take an expense for or a write-off in the current year as opposed to waiting for it next year? Interest is another good one for that. Interest is usually easy to do with that. Okay, so your money's coming in. Your money's either coming into two different places. Usually, unless you have other certain circumstances, but it's usually either going to come into an S corporation or it's going to go into a Schedule C. Schedule C. All right. So if it's going into your S corporation, one of the things that's really important for year-end tax strategy and also for compliance is your reasonable compensation. So I'm going to put that over here. This is your S corporation. This is your reasonable compensation. Right? So your reasonable compensation is really important under your S corporation because it's what the IRS says that you need to be paying yourself at least to run your business. And then, of course, whatever is left over is the dividends or the distributions. But that reasonable compensation is really important for making sure that you have the reasonable compensation for the end of the year. Now, if you don't have reasonable compensation set up, if you have an S corporation and you have not paid yourself as an employee, this is critical crunch time. You need to reach out to a company like ADP or Paychex that's actually going to run the payroll for you. So you need to reach out and you need to make this a priority, because you need to have some amount of payroll running through. Because if you don't, then that's going to be a red flag. I'm not going to say it's going to guarantee you an audit, but the IRS is picking up the enforcement of these S corporations that are not running reasonable compensation, because it's really important that that money is going into the Social Security and Medicare. Because if you don't run reasonable compensation for your S corporation, there's no money being put into Social Security and Medicare. So the IRS is on hot pursuit of these guys for enforcing this kind of stuff. So reasonable compensation is really important. That's number 3. And again, I mentioned it's reasonable compensation because you don't want to do too much. You want to do just the bare minimum. So if you're not sure what reasonable compensation is, there's going to be another video on reasonable compensation. Check that one out and make sure you're doing at least what is a reasonable compensation, but not $1 more, because then it's going to start to get into your dividends and you're going to pay more taxes on it, which we don't want. Our goal here is to pay the least amount of taxes. So that's number 3, reasonable compensation. All right, your next part of the money that's coming out of your S corporation is your 14-day Augusta rule, or your 14-day rental. So this is number 4. Number 4 on our list is the 14-day rental. So this is paying yourself with a check out of your S corporation. So literally all you have to do is, if this is a check from your S corporation, right? This is your S corporation, and I'm going to pay myself, let's say $600, and the $600 is going to you, right? I'm going to put John Smith. John Smith. So literally you take this money out of your S corporation, it goes out of the S corporation, paid out of the S corporation to you personally. And when you pay it out of the S corporation to yourself personally, it's completely tax-free, because you're paying yourself for the rental of your primary residence. So if you have any questions on that, there's a separate video on the 14-day Augusta rule strategy, and that's a cool one. So if you haven't done that yet for the year, create some invoices and figure out how long you've had the S corporation. If you had the S corporation all year long, then you can do 12 invoices. So you do 12 invoices of whatever you're comfortable with. Maybe you're comfortable with $600, maybe you're comfortable with $800, maybe it's $1,000. You just have to figure out what the market rate is. And again, there's a whole video on the 14-day rental. So whatever you're comfortable with, just go ahead and write those checks. You might be asking me, can I just write one check? Can I write one check for $12,000? You can, but you need to have invoices showing that you have done that. And then so you can just do one check for the whole year. The next one is the reimbursements. Again, there's a whole video on the accountable plan and reimbursements, but I'm just going to go in this really quick because this is kind of a end of the year catch-up video. So you got your reimbursements, and your reimbursements are your personal cell phone, your personal home that you use for an office. So whatever that office space is, you use that for the reimbursement plan, and then also your vehicle usage. So this is a great way for taking the cash that's in your business, right? Maybe you have more cash inside your S corporation. You have a good amount of cash inside your S corporation that you need to take out and give to yourself, right? The 14-day rental rule and then the reimbursement is a great way of doing this here at the end of the year. So your reimbursements, like I said, is things like your cell phone, your home office, your vehicle, your personal vehicle. These are things that need to get reimbursed. So just fill out that form, and if you haven't reimbursed yourself for the year, make sure you do that, because it's really important that you have those reimbursements listed out and also reimbursed throughout the year. So again, catching up at the year end, make sure you take care of that. So 14-day rental reimbursements. The last thing is the distributions. So the distributions are the last way that you take money out of your S corporation. If you haven't taken any distributions yet and you have money left in your S corporation, go ahead and take those distributions, but make sure to take these 3 first. because this is tax-free, and this is required by the IRS. So if you have just a bunch of money sitting in your S corporation, don't just take it here first. Make sure to take it in these 3 places first. At least some amount for reasonable compensation, whatever you're comfortable with for the 14-day rental, and then the reimbursement. It's the personal cell phone, the home office, the personal vehicle, those kind of things. And then whatever is left over, you can take for the distributions. Now, Schedule C. If you have the S corporation and the Schedule C, that's great. So, if you have just the Schedule C, that's fine. If you have that money rolling in from here to the S corporation to the Schedule C, that's fine too. Here, the Schedule C, there's 2 really important things that we talk about. One is the kids, hiring the kids, and then the other one is the HRA MERP, the Health Reimbursement Arrangement, or the MERP. So 2 really important things with these guys. This is going to be, so I'm going to call that number 6. Number 7 and number 8, the kids and the HRA. So these are only going to come out of the Schedule C. You lose the benefits with the kids. You lose some of the benefits for the kids when going through the S corporation. So I always recommend that you go through the Schedule C for the kids. And then the HRA, the MERP, doesn't work with the S corporation. So you have to run it through the Schedule C. So with your kids, if your kids have been working throughout the year and you haven't been paying them, now is the time to get caught up with your timesheets and your payment. Now, should you have been paying them throughout the year? Yes. If you haven't, that's okay. Just do one large check. So how do you pay the kids? We need time logs, timesheets, right? So the kids are going to have timesheets, and then you're going to figure out how much per hour, and then figure out how much you need to pay them, right? So let me just give you an example. Let's say you have one child that's working for you and you've determined that they've made $5,000 throughout the year. So you're going to want timesheets throughout the year, not just like, oh, I made $5,000 this month, because then that could be looked at as a 1099. So you want to do the timesheets, figure out how much per hour, and then let's say they made $5,000. So you can write them one check here before the end of the year out of the Schedule C for the $5,000, as long as you have the timesheets and then some sort of contract saying that it's okay to pay them as the employee late. I mean, that's not really important, but it might be important to have that on the contract. All right, so that's for the kids. So you want to make sure that you pay your kids something before the end of the year. The MERP is the same thing. So hopefully you have a spouse. If you don't have a spouse, then you have this on a separate corporation, a C corporation. But the same rules apply. Your spouse or yourself needs to have timesheets, whatever the per hour rate is, and then whatever that rate for the reimbursements is. So the HRA and the reimbursements, of course, there's a whole video on this. There's a video on the kids. There's a video on the HRA MERP. But essentially what we're going to be doing is saying, okay, we need to reimburse our medical expenses. So if you don't know how much you've had in medical expenses, this is your out-of-pockets, your deductibles, your co-pays, your doctor visits. If you had anything that wasn't covered by insurance, like LASIK or dental work or glasses or things like that, these are all things that become covered under the HRA MERP. There's a couple things that can't, but one of the biggest things is your health insurance premiums. Your premiums are going to go on the first page of the 1040. So don't feel like you can't take them, because you still can take them. You just don't take them through the HRA and the MERP. Okay, so if you haven't done this and you have the S corporation, then the S corporation needs to pay your Schedule C. So let's say you've got $5,000 for this and $5,000 for this. Well, then you need to move $10,000 from your S corporation into your Schedule C. How do you do that? You use an invoice. You say that my Schedule C was performing some sort of business service. Maybe it's accounting, maybe it's bookkeeping, maybe it's marketing. Marketing, I like marketing the best for the Schedule C. But essentially then the S corporation pays the Schedule C, let's say $10,000 for that. And then this zeroes out because $5,000 of it goes to the kids, which is completely tax-free. $5,000 goes to the HRA, the MERP, which is completely tax-free. So the $10,000 of income gets distributed, and then there's no taxable income to the Schedule C. This is really important because you're going to see that there's no taxable income to the Schedule C, which is essentially giving you a $10,000 deduction here. I know it kind of looks complicated, but that's what you want to do. So these are the top tips that you want to do for kind of the flow of your cash flow through your business. I want to touch on a couple other things, so I'm going to erase this. So pause the video here if you want to look at this again. Feel free, of course, to go through this video with any other questions that you have. Just let me know. And of course, there's videos on each one of these so you know what's going on. All right, so actually, I'm going to pause this really quick and then see if I can pause this. That's fine. I'm just going to erase it. All right. All right. Okay, so there's a couple things that I want to talk about, the year-end strategies, things to do. So number one is any purchases that you have, right? So anything that you want to buy, now is the right time to do it. So let's say you need a new cell phone or a new computer. You're thinking about buying something, a new car or a new truck. That's a great time to do it. A vehicle, if it's a heavy SUV or a truck, over 6,000 pounds, then you can take the Section 179 and the bonus depreciation. I'm going to put it right here. Section 179. I've got a whole video on Section 179 and trucks. So if you're thinking about buying, a laptop or a computer or a cell phone or anything like that, now is the right time to do it. You can write all those off. Also, if you're thinking about buying a vehicle, a new vehicle, this is a great time to do it as well. All right, what else we got? Home office, if there's anything new for the home office that you need, maybe you need a new desk or a new chair. You want to say, hey, we had a great year, we're going to buy ourselves a new chair. That's fine, your home office. And make sure that you're also deducting the home office through the S corporation, if you have an S corporation, through the S corporation reimbursement arrangements and employee reimbursements as well. Next thing, holiday travel, dining, entertainment. So the 2018 Tax Cuts and Jobs Act completely got rid of entertainment, but you can still do things like travel and meals. So I'm going to put travel and meals. So a great way to deduct your travel is through rental property. So let me give you an example. Let's say, so I live in California, and let's say I have a family member that lives in Michigan. And we want to go up to Michigan every year for Thanksgiving. So it would be a great idea for me to buy a rental property in Michigan so that every time that I go to Michigan for Thanksgiving, I can deduct and write off my travel expenses because I have a rental property there. So having a rental property where you want to travel is a great way to write off that travel or expend that travel. So rental property. Now the nice thing about rental property is that it doesn't matter what time you go and it doesn't matter for how long you go. So with business, to have it typically with your business trip and business travel, you have to have more than 50% of the time. But that's not true with rental property. Rental property, you just have to go and visit the property to make sure it's still there and still good. And you can write off that travel, right? And again, don't get crazy with this. You don't want to write like $20,000 off, $20,000 off your trip with off of travel, off your taxes, because you're just going to create some red flags. But a couple $100s for plane tickets and hotels and things like that. Don't get greedy with it, but you can write off a lot of your travel expenses with it. And then meals, as long as they're business related. The biggest problem with this is that typical holiday meals we're going to have with our family members, and the IRS doesn't really like us having business discussions with our meals with our family. But if you want to do things with employees or your vendors' families, other things like that, meals is the best time to do that for these holiday meals. And then also, if you want to get together your employees and have an employee party, that's 100% deductible. It's unchanged by the 2018 Tax Cuts and Jobs Act. So as long as it's bringing the employees together and it's kind of team building for the employees, you'll still have 100% deduction for that. So if you don't use the travel, if you don't get a rental property for the travel and you just want to do business, maybe you want to do a seminar or a lecture or something like that. So let's say I wanted to go up to Michigan and I want to spend 3 days with my family. Well, if I did a business seminar or a business lecture or something like that a day before or the day after, 1 or 2 days, or had some meetings with some people up there, that's a great way to introduce that business with the travel, so I can get that deductible. The only thing, remember, with business is it has to be 50-50. It has to be 51% of your time or greater. It has to be greater than 51% of the time is designated to business for that travel. All right, so rental property, family members, payroll, healthcare. Okay, if you haven't done so already, I also recommend looking at the HSA. The HSA is a health savings account, not the health reimbursement arrangement like we talked about before, the MERP. This is different. This is actually a savings account. Savings account. So if you have a high deductible health plan, I think go like HDHP or HDLP. If you have a high deductible health plan and you don't have an HSA, look into getting an HSA, HSA savings account, because this is the cream of the crop of tax deductions, because you get a tax deduction when you put money in, and then you also get that tax-free when you take it out, and it also grows tax-free as well. This is the cream of the crop of tax deductions. You can only take about $6,000 to $12,000 a year. It changes every year. You can look up the minimums and the maximums of what you can do. But if you have a high deductible health plan and you don't have an HSA, you need to look into that right away and fund that HSA before the end of the year. It is critical. All right, the next thing I want to talk about is retirement plan options. So your retirement plans. So this is things like your SEP or your Simple or your 401k. If you don't have one of these so far and you're thinking about it, I highly recommend that you set it up here before the end of the year, and you have up until April 15th or October 15th. If you extend, you can get an extra 6 months on that. But you need to set up your 401k plan or your SEP plan before the end of the year. So you've only got a couple more weeks here of the year to do that, setting up the retirement plan. Personally, I like the 401k much more than the SEP. It's a lot more flexible. You have the Roth option as well. But the 401k is cool because you can actually take loans out on it. I might change this on a future video, but right now the 401k plans that I'm recommending are through TD Ameritrade and through E-Trade. Both TD Ameritrade and E-Trade both offer free or very low cost plans, and really easy to set up, and then you can also take loans out on the 401k as well. So especially for real estate agents and self-employed people, the 401ks are super critical because you can take loans out against your plan without actually distributing the money or taking the money away. Because if you take the money out, you're going to have taxes on it and penalties on it. You don't want that. You want to be able to take a loan out if things get, if there's a downturn in the market, or you have trouble with your business, or you just want to reinvest that money. You can do that through the 401k. Are you going to have great investment options with those? No, probably not. If you want to self-direct your own 401k, those two that I gave you is not a good option. You can go through other companies like Equity Trust, Pensco. There's a couple other self-directed IRAs or self-directed 401ks if you're interested in self-directing. If you don't have any interest in self-directing, I don't recommend it. Just stick with the stock market. They're going to have some no load and some no fee EFTs, exchange traded funds, which are going to match the market, right? They match the NASDAQ or whatever market, and you'll be able to be aligned to the market. So, and very few, and I probably shouldn't go too much of this, but essentially very few investment professionals can actually beat the market. So going to an exchange traded fund or an EFT that matches the market, or it's invested in the market aggregate, is a really good way to go. So that's your retirement plan. Make sure that you look into that. I'm not going to write those up, but I might have those somewhere else. But right now I'm recommending TD Ameritrade, and E-Trade, because they both have the 401ks with a loan option. All right, that's all I wanted to cover from here. Let me double check and see if I wanted to cover anything here. Yeah, if you have any vacations set up, just try to figure out if there's a business related reason or business related thing that you could do when you're doing your personal vacations or your holiday vacations. And then if not, and if it's going to be a recurring thing, maybe you want to look at getting rental property for that. And that is it. All right, so thank you so much for taking a couple minutes here with me and going through these year-end tax strategy tips. If you have any other questions, feel free to drop it in the comments or email me, contact me, however way you want to do it. And I'm more than happy to walk you through any of this stuff that we've talked about in more depth and detail. Thanks so much.